Hello, everyone. We are going to give everybody a couple of minutes to get loaded into the session. We were just talking behind the scenes about American history, and we're about to celebrate the 250th birthday of the United States. And Fritz has a public service announcement of something we all have to look into.
Yeah, yeah. Well, thanks, Jody. Yeah, I came across this account on Twitter or X now that tweets events from 1776 as if they were happening live right now. And so it's really interesting, especially getting closer to the 4th of July, seeing, in sequence kind of what was going down at that time. So
Yeah.
encourage you to all look
And
it
you
up.
said you got a tweet about Thomas Jefferson signing the Declaration of
Yeah,
Independence.
yeah, and just all these cool kind of current events from that time. So it's called 1776 Live. I would definitely encourage you to take a look.
That is that is amazing. And then Amy was saying behind the scene, if they only had the Netflix documentary and Twitter when she was in high school, she may have enjoyed her government class a little bit better.
Yeah, yeah,
When X can help you prepare for your government quiz.
yeah, exactly. The kids have it easy these days.
Yeah, for sure. Give it just a few more seconds and then we'll get started. The numbers are continuing to climb a little bit, although I will say I think a lot of people are taking advantage of the long weekend and are off this week or off next week. So. All right. Welcome to the SIP, everyone, a space where conversation fuels connection and collaboration drives innovation, and industry leaders come together to tackle challenges, just like catching up over coffee or over a cocktail to discuss the 250th birthday of the United States. The SIP is all about meaningful discussion that moves us forward. And at TMC, we're committed to fostering forward-thinking environment where our members thrive, grow, and make lasting impact. Today, we are here to share insights, real world case studies, and strategies that highlight the power of working together. A big thank you for taking the time out of your day to join us. We won't just talk about X and the Declaration of Independence. Today's show is proudly sponsored by the Zebra. Insurance has quietly, I don't know if it's been so quietly, but has become one of the most consequential line items in the mortgage equation. It's not always getting the attention that it deserves at the point of sale. And we're going to dig into why that needs to change and who better to help us with that than the team at the Zebra. Joining me today is Fritz Marazon. He's the strategic partnership manager at the Zebra. Fritz, welcome to the SIP.
Hi, Jody. Thank you for having me. Excited to be
Yeah,
here.
for sure. I always get distracted in the beginning. All of the note takers are coming in and messaging me that they're here, and so I always like look down, like, oh no, they're not. No one's asking a question. Please do feel free to ask questions, and I will try to hit those up throughout the episode. But Fritz, let's dive in and start with the numbers that should be getting everyone's attention. So the average homeowner is now paying close to $3,000 a year for homeowners insurance nationally, and the rates have climbed roughly 30% just since 2023. That's not a blip, it's a kind of structural shift, and it's heading higher again in 2026, as many line items are. But walk us through what is driving this increase.
Yeah, so I think since 2023, we've seen, as far as construction costs are concerned, a lot of inflationary pressures. Kind of supply chain failures as well as tariffs on materials, extreme weather events have led to there being a huge increase in replacement costs, which are squeezing insurers. And so a lot of insurers are being forced to increase their rates. Subsequently, that's hitting the homeowners pretty hard.
Yeah, it's unfortunate that we do see that increase even in areas where we don't have a significant amount of natural disasters, but it is part of the equation. Um, So the stat alone should change how we think about affordability conversation from where you sit at the Zebra. How much of that pressures are lenders actually seeing show up in real time before a borrower even gets to the closing table?
Yeah, that's a great question. I mean, I think when people are evaluating the affordability of homes, this is in the past, this might have been somewhat of an afterthought where, when it's clear to close time, then you can go ahead and get your insurance. But now this is being factored into, the total affordability of a home and how much home can I really afford. If you
Yeah.
look at some markets like Florida, where there's been a lot of real estate activity in the last 3 to 5 years, the premiums there are growing at a faster rate as well. So I think when you look at the whole picture of home affordability, the insurance is quickly becoming the number two or number three most expensive part of owning that home, and is driving people to kind of reevaluate their entire shopping experience. So, I think being able to introduce at least in directionally what these premiums might be for buyers earlier in the process is going to be really valuable.
Yeah, I can remember the days when the loan officer would throw $100 for taxes and $50 for homeowners insurance on the 1003. And yes, when I started in the industry, that 1003 was carbon paper, handwritten
Yep.
1003.
Yep.
But with thinking about 250 to $300 oftentimes just for a month just for
Yep.
homeowners insurance, and that can make a significant difference in the number of loans that are approved or declined. So ensuring that you know what that number is early in the process can make the difference between how much home you should be shopping for or not shopping
Right.
for when it comes to that. So definitely something that we need to, we as lenders, we get caught up in the line items that are the right now, the highlight is the cost of credit, and aren't necessarily considering those other things, but it's everywhere that is driving up. We had a group of lenders. We were in DC, and one of the agencies, we were talking about the increase in condo premiums related to the new reserve requirements. And the comment was made, well, they should only go up like on average $30. And it's like $30 means a lot to a
Yeah.
home buyer today and could be the difference. Like, I would love to have the all of the data so that I could show like what the difference would be, like the break in where we typically see the debt to income ratio break. And if we just had 10% less in all of the costs from taxes, homeowners insurance, what that would open up for home buyers to qualify for. But since we don't have that data, we'll move forward.
Yeah. Yeah.
Um, Let's talk about who's feeling this the most. The first time home buyers are already at a record low share of the market, and we're seeing older and older first time home buyers, and they're putting far less down than repeat buyers. So why are these groups so exposed here?
Yeah, I mean, I think what you mentioned about the down payments, I mean, 10% on average down for first time versus 23% for repeat buyers. I think that in itself tells a huge affordability story, where the repeat buyers oftentimes have equity that they're able to put into their kind of secondary purchases, whereas the first time home buyers are often kind of pushing it off to the payment, and as that payment swells, they're going to be looking for the finest margins of where they can save money. And as we just mentioned, the insurance piece of that equation is starting. I mean, in some markets, it's far beyond taxes, which are always a consideration for people. And being able to save, like you just said, $50 or $100 a month on your insurance premium is serious savings. And that, I think, from a debt to income standpoint, from an affordability standpoint, that's hugely important. So, we want to be sure that those buyers can find the best option for them, compare as many as possible, and ultimately kind of get the guidance that they need to feel confident in their purchase, both on the home and the insurance.
Yeah, for sure. And yeah, you can't shop your taxes,
Right.
right? So you should shop what you can.
Yeah.
Also, if you're going into a condo, you can't really shop your association dues. I guess you can if you'd have to change the property you were choosing though. So that's a tough combination with thin margins, less experience navigating a policy, and most of it is they get it wrong or they wait so long in the process that they feel as though they have to make a decision so they don't have the opportunity to shop. So let's talk about shopping. Here's what is interesting to me. Borrowers are not waiting until closing to think about insurance anymore, which oftentimes they were. It's like you would get a clear to close, like, oh, I got to go get a policy. And again, we're still dealing with the $50 line item a month on the 1003. So tell us what the shopping behavior actually looks like today and how forward in the process are home buyers actually looking for insurance?
Yeah, so I mean, the home buyers right now are starting this process kind of at origination. Once they have an accepted offer or once they're thinking about putting in an offer, I think a lot of times that's when it really starts to get the wheels turning. And if you look towards the first-time home buying crowd, they generally skew slightly younger and they intend to begin their insurance purchasing process online. Now, they might not always want to finish it online because there's a lot of value in having an independent agent who's willing to represent you. And so
Mm.
that's the mix that we're trying to shoot for here at the Zebra as well is bringing the best rates to folks early on or the best that we can find within our network and coupling that with the expertise of agents so that folks, as the close date comes up, they can feel confident that they have the right coverage and be able to to feel protected. But ultimately, yeah, they're looking far earlier and they're reshopping a lot more. There's been a lot of talk in our industry around the kind of commoditization of personal lines insurance, and as people they're getting bombarded with ads and there's so many options for them to look at. It's just kind of a big price war, and so with these pressures, I think being able to offer the right price coupled with the advisory experience is really important.
And you shared some statistics in our prep that two-thirds of home buyers are getting quotes on average, and 39% are getting three or more, and
Yeah,
62% are planning to reshop within 12 months, compared to 39% of other homeowners.
right.
If nearly two-thirds of the first-time home buyers are planning to revisit their coverage within a year, what does that tell you about when lenders should actually be having the conversation?
Sorry, could you repeat that question, please?
Sorry, I was taking a drink. I said, so with nearly two-thirds of home buyers planning to revisit their coverage in a year, what does that tell you about when lenders should actually be having the conversation with their home buyers?
I think that tells us that they need to be having that conversation kind of early on in the process so that they can feel confident that they're at least in the having the right conversations to find the cheapest insurance. Because I think these reshopping plans are primarily dictated around price. And so if they feel confident in their ability on an ongoing basis to have the best price, then
Yep.
that's what's really important. I think when you look at what people are looking at when they're shopping for homeowners insurance, I mean, affordability is a huge part of that. And I think that's what's driving a lot of those reshopping pieces. And if the lender is able to kind of bring some of these affordability conversations in early, I would hope that would, kind of reduce that 62% figure.
Yeah, I see it also as a retouch base opportunity. So many times when you're in a rising rate environment, you look for reasons to reach out to your existing clients that are in your portfolio. And if you have some skin in the game on the homeowner's insurance piece of it, it incentivizes the loan officer to reach out for a touch point when they're getting close to the year anniversary to make sure if they are shopping that they're shopping with you. But connect this back to the loan itself. When insurance gets shopped alongside the mortgage instead of bolted on at the end, what is actually changes for the lenders, not just for the borrowers?
Yeah, absolutely. So I think being really clear on that debt to income math is hugely important. That way, when you are approaching that clear to close process, you're going to have far fewer escrow surprises. And with this big gap in kind of um, what I guess people are expecting to be paying for their insurance versus what they might be. I think being able to introduce that to the conversation earlier is very important, so that you can kind of bring up some other levers that you can pull during that closing process.
And there's a savings story in this too. So tell us about the gap between newer homes versus older homes.
Yeah, so there's about an $800 a year gap between insuring new builds versus older homes. I think there are a lot of contributing factors to that. I think the resilience to natural disasters is a really big part of that. So when you look at some of these catastrophe-prone areas, that's going to be a huge part of that conversation where building codes now have gotten to the point where some of these resilience factors can be built into the homes. In addition to that, these newer builds the supply chains are more compatible with where we are now. And so I believe that those are what's kind of driving down some of those inflationary pressures that we've seen since 2023 or so.
And we have a question in the chat. We'll go to that in just a second. But if you can surface the kind of savings for a borrower before they are locked into the rate and policy, how much of a difference does that make in getting the deal across the finish line?
I think that could be huge. I mean, if you look at $800, plus a year, I mean, whatever a savings amount could be, as we were saying earlier, like these margins are becoming very thin, especially if you look at a young family who might be purchasing a home. It might be somewhat of a stretch for them. So, any little bit that you can get, I think can be hugely helpful. And $50 a month could go a lot further than you would think.
Yeah, absolutely. So on the question side of things, we're going back to the shopping piece of it. But if you change coverage every year, does that have an impact on you? Someone in the chat was told that it's held against you and could impact your rates if you're shopping annually.
It does. So typically, there would be discounts for staying with the insurer for longer, as opposed to being punished for moving carriers. So I wouldn't expect to necessarily be punished for it, but you might be rewarded for your loyalty.
And so, Steve, thank you for the question. Hopefully that answers it. If not, pop back in on the questions. So we need to hear this multiple times, and that's why I keep like asking a similar question so that we can reinforce this. But here's part of that I think a lot of lenders don't realize is where borrowers are actually starting their insurance search today, and is it before they even engage with the lender? Is it when they're engaging with the referral partner, the realtor? So, what is your perspective there?
Yeah, well, I think surprisingly to me, not as many people share the same passion for insurance that I do. So this might be more of an afterthought for a lot of other folks. And so I think what we're seeing is that if they are looking before an offer is in place, that's generally very exploratory. They start getting serious about it once they've engaged a lender who is offering some of these guide rails to the closing process. Where, of course, this will be a hugely important part from a lender risk standpoint, is making sure that the home is insurable.
Yeah.
So, a lot of times the relationships that the lenders have will dictate where this person goes. I do think that there's a generational shift happening where, if you look at some of the second time home buyers who might be later in their life, that they may still go to the State Farm branch down the street. I think there is a shift towards going to comparison sites, or direct to carrier websites as well. Again, kind of going back to this commoditization, people understand that it's just a lot of times we can get similar coverage, but for a different price based on what market I'm in, what my risk profile looks like. So, by offering all of these separate companies and carriers put together, I think that provides the customer with a lot of confidence that they're able to find the best rates and ultimately, the best coverage for their situation.
And are you able for those that are listening, like I know what the zebra looks like and I know what the process is and what the output is when a home buyer is shopping for insurance, but can you walk through like operationally what it would look like to a lender and to a home buyer and what the comparison looks like? How many different options are there? Kind of walk us through that.
Yeah, so we'll just do a simple data collection, in conjunction with the lender, and the insured themselves. For TMC members, we can discuss some of the technical capabilities we have to ingest that data autonomously via API. However, if we were to go for kind of the lightest weight type integration, we would have the borrower visit our website. They'd put in their address, enter in some ancillary details that the insurers typically like to know. I mean, think about the age of the roof, think about how far away you are from a fire station, things like that. Um, and then we'll reach out to our kind of portfolio of carrier partners, if you will. The user is then able to select one of three different coverage types if they want to go for more of a lightweight but cheaper version, or if they want to be very confident in their protection, they can go for a heavier weight, higher limit option as well. We'll present three different options, and then we have our in-house agency. So we have about 100 agents on staff where the user can call in and we'll pull up their record and help walk them through those options as well, which is very helpful a lot of times, especially if you're a first-time home buyer, not understanding what a dwelling coverage might be or what these different coverages might be. So I think it's really helpful to chat through a licensed representative around that. And
Yeah.
then, from there, if everything sounds good, we'll just kind of line everything up for the close date. We are able to initiate a policy and say, hey, look, okay, it's going to start on July 15th. And so that's something that we can kind of have ready so that the lender and the borrower all have confidence in everything being okay once July 14th rolls around.
Yeah. And, I want to point out like that also creates operational efficiency, especially when we have I mean, we would all as lenders welcome increased production, but when production numbers get high, and we saw this in 2020 and 21, where you'd wait forever to get updated policies. So besides the cost saving for the consumer by embedding this into your workflow, you also have the ability to streamline the process where you're getting the policy returned in a shorter period of time,
Yeah.
less back and forth because it is embedded into your workflow so that you don't experience those delays because the processor waited too late in the process to request the policy, and there's really backed up turn times at the outside of the process.
Right, exactly. And we'll work with the borrower on a mortgagee clause and making sure that the right documents get routed to the right place, just so that we know that there's going to be nothing holding up the closing. That's our primary concern.
Yeah. And I think it also, there's definitely especially if the home buyer has come to the loan officer first and they see the loan officer as a trusted advisor, them going out and working with someone creates a gap in their trust because they already established one. So sending them outside can further have impact on that. So, what does it take a lender who wants to step into that space to be able to make the change so that they can offer the insurance within their workflow and early in the process?
Yeah, so I'll be a primary contact to help walk you through that. It's a pretty easy setup for us, and I'd be happy to talk to any of the lender members to initiate that. But ultimately, I think on our vendor page up on TMC's website, my contact information should be there. I'd be happy to share it here as well. And if you just want to reach out, happy to schedule some time, and we'll kind of walk through what that process looks like. figure out kind of what the technical requirements might be. If we do want to facilitate an integration, happy to put you in touch with our team to do that. Or if we want to go something lighter weight, we can look into that as well. So yeah.
And I love that you have humans in the loop to help home buyers through the process so that it isn't just, throw some information in
Right.
a website and then not have people that can help guide you through the process. For our TMC lender members, there's an upside for all of you. And if you're not a lender member, we'd love to talk to you. We launched last month, we launched the Collaborative Impact, where we talk about the benefits of the network. And it's for our lender members to gain a better understanding of that. But we also expose that to the entire industry so that lenders can see what they're missing out on. So our next episode is on July the 9th, and it is specifically around TMC membership and how we can help pay you back. So the Zebra will be featured on that as well. So please join us on July the 9th for the collaborative impact. And it's just one of the ways in which, and we're very excited for the Zebra to become a preferred partner of TMC. Um, Not just for the cost savings, but for your partnership, creating efficiency within our lender members' workflows and also giving them an opportunity to embed this into their platform. So thank you for joining us today. And also thank you for being a part of TMC. And that's a wrap. So it's been an incredible conversation, and we truly appreciate the insight shared today. A huge thank you to the Zebra for sponsoring this episode and to Fritz for lending his expertise. And of course, a special shout out to our listeners. Your engagement really is what drives us forward. We'll be back on the SIP on July the 7th for the TMC community and all of our LinkedIn listeners at 2 p.m. Eastern Time. And then July the 9th at I believe it's at noon. It's a new show, so I can't remember when I'm supposed to be where, but it's the collaborative impact, and we're going to describe the benefits that pay you back in this episode. And if you're not yet a member and want to explore that, please reach out to me directly. I'd be happy to help you along the way. And until next time, cheers. Thank you, Fritz.
Thanks, Jody.